Interest rates are expected to drop again in July. This would be the second time the key interest rate comes down this year. It's not guaranteed, and that's something you really need to consider. The reality is that what happens with the key interest rate affects what people do. So a drop in the rate could get people thinking if now is a good time to get into the market if you're looking to buy a home, or if you're selling, you might be thinking that more buyers could also mean that it's a good time to sell. And whichever side of the table that you're on, a lower rate would likely help you out. You could already be someone who has their own home and is looking into refinancing, or you're up for a mortgage renewal and you're looking for the best mortgage rate. As a buyer, you're also shopping around for a new mortgage with your bank or your mortgage broker for your next home. Also trying to get the best rate possible or see what options you have to keep the payments low. So in this video, I want to share with you what another rate drop of 25 basis points could do for your mortgage. I'll use this townhouse in the Willowdale community of Toronto. It's listed for $1.1 million, so we use that as the purchase price. Your down payment is the amount of cash that you have available to put towards the home purchase. Buyers need this to get their mortgage loan, and they'll normally put down anywhere between 5 and 20%, sometimes higher. If the property's purchase price is less than $500,000, then the down payment can be as low as 5%. But if the property value is more than $1 million, like in this example, then the down payment has to be at least 20%. So that's what we'll use, which is $220,000. And your down payment can be more than 20%. It can help reduce the amount you need to borrow to finance your home, and can also help you to potentially get a better rate from the lender. And also, having a higher down payment increases your equity share in the property, and also keeps growing as you make your mortgage payments. And after making your down payment, you're left with a balance of $880,000. This is what you'll need a mortgage for. This is your legal agreement between you and the lender to get the financing for your home purchase. You're agreeing to pay back the loan amount plus interest over a period of time, usually amortized over 25 or 30 years. You end up getting approved for a mortgage rate of, let's say, 5.5%. We'll say this is a fixed mortgage rate over the 5 years. The payments and interest are amortized over 30 years. And in the first 5 years, your interest rate isn't changing from that 5.5%. Some people like fixed mortgages because they know that their payments aren't going to change over that 5-year period. And the 30 years is the length of time that you agree to pay off your mortgage. In Canada, if you're making a down payment of less than 20%, you can only get a maximum amortization period of 25 years. So by making your 20% down payment, you can potentially unlock the option of a longer amortization period of 30 years. The benefit is that you get a smaller monthly payment, but this also means more interest paid over the life of your mortgage. Going for lower payments with higher interest versus higher payments to pay less interest is a debatable topic, so let me know in the comments what you think. At 5.5%, your monthly payment is just under $5,000. The payment is calculated based on everything we just looked at. That's the purchase price, your down payment, which leads to the mortgage amount, the approved interest rate from the lender, the term you get that rate for, the amortization period, and the monthly payment frequency. You'll be surprised to see how much the payment changes just by making a small change of 0.25% in the interest rate. And I'm purposely going with just a 0.25% change because that's what another rate cut would likely be if we do see one in July later this year. After those 5 years, you'll pay down about $45,000 in interest. The principal that gets paid down is just under $15,000. This is money that's directly paying down the balance of the mortgage. The more you pay down in the balance that you owe the lender, the less you pay in interest over time. Okay, so now let's make that one change. Let's update the interest rate to 5.25%, but keeping everything else the same. Your monthly payment goes down to just over $4,800. That's a difference of $133 per month. Over the same 5-year period, you'll pay down about $42,000 in interest. The principal that gets paid down is just over $15,000. The difference is that over those 5 years, by going with a lower rate of just 0.25%, you're only making a dent of $528 extra to your mortgage balance. The savings are in the interest paid to the bank, which are just over $2,000. Okay, so now here's the big question. Was it worth waiting for time to go by to see if the interest rates were going down another 0.25%? The bigger question, what's happening with home prices while waiting for the rate to drop down? When the Bank of Canada brings down the key interest rate, like they're expected to do a few more times throughout the rest of this year, home prices tend to go up. It doesn't happen overnight, and prices go up over time. This is because increased affordability usually leads to higher demand for homes, and this can drive prices up, especially in a competitive market like Toronto, where housing supply is known to be always limited with more buyers competing for the same properties. That increased demand could lead to bidding wars between buyers, pushing prices even higher. So again, just ask yourself, is it worth waiting for the rate to drop a 0.25% every few months just to save an extra few $100s over 5 years while home prices have a chance of going up? It's always a debatable topic, and my advice still stands that if you're looking to get into the market and you have everything in place to do it, just do it, especially if you're buying to live in the property for 5 or even 10 years, because in that time, there's a good chance that property values will go up, especially in the current market. Mortgage rates are likely to come down during those 5 years as well. now. But look ahead a bit further. In 5 years, if you decide to sell your home, it'll likely be at a higher price than what you paid for today. This is based on the fact that today, home prices are down and the market is slow. You'll capitalize on your home's value when you sell, since your home is an asset that appreciates over time, which is another way of saying that the future market value of your home is going to be more than what you paid for. So the equity you have in your home grows. Yes, the next home you'd buy will probably also be more expensive, but mortgage rates are probably going to be down in 5 years. I would honestly be surprised if you were getting a mortgage rate in 5 years from now at 5.5%. RBC already forecasted that the bank's rate is going to be 3% in the next 2 years, which should also bring mortgage rates down. A lot to consider, but if you're considering all of this and not taking action when you can, then you're also missing the opportunities to build equity through real estate and to grow your net worth. I hope this video helped you and cleared some of the confusion you might have had if you were thinking about waiting or not waiting for rates to come down further. And if you gained value from this video, make sure you hit subscribe. Thanks for watching, and I'll catch you in the next video.